Okay, student, let's start another practice class, I would say. Part A, discuss how the Helm property should have been accounted for and explain the implications. I hope that everyone can see the question. But I'm the only one who can see the question. Please quickly reply. Yes, you people can see. The question, discuss how the Helm property should have been accounted for and explain the implication means consequences for the financial statement and debt covenant of fiscal term. Now, let me tell you one thing. Normally, what happens when your organization takes a really big amount of loan. So obviously, when someone is giving you a really big amount of loan, so normally you will not get a loan unconditional. Then normally such loans they come with conditions. Covenant means conditions. And you have to make sure that you're not supposed to have to do the breach of that covenant. Logically, breach of the covenant means the loan which had a, let's say, maturity period of 10 years, breach means the maturity comes immediately. So breach of debt covenant means the maturity comes immediately. Breach of debt covenant means you have to reclassify your long-term liability to the current liability. And one more thing, breach of covenant means obviously if the long-term loan becomes the current liability, then you should also be thinking for the going concern assumption of the business might not remain valid. Because how can you pay so quickly such a big amount of loan? So it means that whenever you have taken a debt with the conditions, so then you have to run a business in such a way that there should not be a breach of covenant. So discuss how Helm property should have been accounted for and explain consequences of financial statement and the debt covenant. I've just tried to give you the idea. Part B, in accordance with IFRS 15, revenue from contracts with customers. How many steps do we have in IFRS 15? Can I say 5 steps? And we recognize the revenue in step number 5. When all the performance obligations are satisfied, then we recognize the revenue. Obviously, until unless you have not performed the performance obligation, you have not fulfilled the performance obligation, you cannot recognize the revenue. In accordance with IFRS 15, revenue from contracts with customer, discuss whether revenue arising from the sales contract should be recognized on a stage of completion basis. Wow. 4 marks and a very specific question. You have to just tell us. Should we recognize the revenue over time or point in time? Repeat. In accordance with IFRS 15, revenue from contracts with customer, discuss whether revenue arising from the sale contract should be recognized on a stage of completion basis means over time. So should we recognize the revenue over time or point in time? So in that area, obviously, number one, there's no need to write all the 4 steps of IFRS 15. Never do that. Because if you just start writing the 5 steps, even though examiner has not asked the 5 steps, you will not be getting marks. You have to share the knowledge, but the relevant knowledge. Repeat. Just by reading the name IFRS 15 does not mean that you just blindly start discussing each and everything. No. You just need to discuss one thing over here, that should we recognize the revenue over time or point in time? And recognizing the revenue over time, you should obviously know few things. That when do we recognize the revenue over time? So we do recognize the revenue over time if customer simultaneously receives and consumes the benefit from the seller performance as they perform, for example, services. If you are providing services to someone, so obviously the customer is simultaneously getting the benefit. So you should be recognizing the revenue over time. Another point is the seller enhances an asset that is controlled by the customer. The asset is not in your control. It is in the control of the customer. Okay. You should be recognizing the revenue over time. For example, let's say, just an example, okay? Assuming there is a building which is already constructed, okay? And now, let's say the owner has asked your organization to just construct one more, let's say, room. So obviously, you can say it's a little bit modification, but that asset is not controlled by me. That asset is actually controlled by the customer. And what I'm doing, I'm just enhancing that asset which is controlled by the customer. In that case, also I'm going to recognize the revenue over time. And the last point of IFRS 15 is if the asset has no alternative use. So if asset does not have any alternative use, it means whatever work you have done, you can ask for the payment. Whatever work you have done. Again, for example, let's say you are just constructing a building for someone. Obviously, you are not the owner of land. Owner is the customer, and you have completed 30% of the work. If something goes wrong, so you do not have any alternative use, you cannot sell your work to anyone else. So in that case, obviously the customer is bound to give you at least the payment which is equal to whatever amount, whatever percentage of the work you have done. In that case, you will be recognizing a revenue over time. So what I want to say, obviously in SBR, when you are answering the question, obviously the step one is you have to share the relevant knowledge, not the entire IFRS, not the entire IAS. Only the relevant part, like over here, the relevant part is you should tell us when do we recognize the revenue over time, and then you have to apply in the scenario. So knowledge sharing, step one is knowledge sharing, step two is application. But please, knowledge sharing will only give you 40% marks when you have shared the knowledge only to the relevant point. I hope I have tried to clear this. C, explain any ethical issues which may arise for the managing director and accountant for each of the scenarios. Ethical issues. Students, I think in the previous revision classes as well, I put really big amount of emphasis on this topic, ethics. C and SBR, we know that 30 marks are for the consolidation. Minimum 5, maximum it could be even 8 to 10 marks for ethics. 2. Third, alternative performance measures. Fourth, ISS and IFRSs, and obviously the current issue. So you should not ignore while preparing yourself for the paper the area is of ethics. They are saying explain any ethical issues which may arise for the whom? Managing director and accountant. I think we did discuss many times again. It is not only the responsibility of, let's say, managing director to be ethical. Obviously, even you are an accountant, let's say, either you are an ACCA affiliate or not. Even you are a student and doing this accountancy job, ethics are applicable on you as well. So let's try to read the scenario and answer ABC properly. The following is an extract from the statement of financial position of Fiskerton, a public limited entity as at 30th September 2008. Non-current asset, current asset, equity share, other component of equity, retained earnings is this. Non-current liabilities, current liabilities. The bank loan has a covenant, means condition attached whereby it will become immediately repayable. Should the ratio, gearing ratio, long-term debt to equity, the long-term debt is 50,000. Long-term debt is 50 and the total equity is this. Share capital, other component of equity and retained earning. Long-term debt to equity of Fiskerton exceeds what? 50%. So calculator, what is the percentage right now? 10,000 plus 20,151 plus 70,253. So let's see what is the percentage right now. 49.78%. Right now it is it's almost very close to even 49.8. Obviously, it is almost close to 50%. But it should not exceed 50. Okay. Fiskerton has a negative cash balance. As at 30th September exit, negative cash balance means the liquidity position of the business is poor. It means if something goes wrong, they cannot afford that burden. Plus, right now, the gearing ratio is almost near to that. This right now breach has not occurred, but they are very near to the breach. Okay. Hallam property included within the non-current assets of Fiskerton is a property in Hallam which has been leased to Edingley under a 40-year lease. Hallam property included within the non-current asset of Fiskerton is a property in Hallam which has been leased to Edingley under a 40-year lease. It means we are lessors. Lesser is the one who provides the asset on lease. When it comes to lesser, so we know that under IFRS16 leases, for lesser still we have two types of leases. One is finance lease and another is operating lease. The property was acquired for 20 million on October X7 and was immediately leased to Edingley. The asset was expected to have a useful life of 40 years at the date of acquisition and have a minimal residual value. Fiskerton has classified the building as an investment property and has adopted the fair value model. Stop here now. Discuss how the Hallam property should have been accounted for and explain the implication on debt. We'll come to that debt covenant. Let me just explain this area. Students, IFRS 16 leases, lesser accounting. See, you have to first explain that it is the responsibility of the lessor to classify the lease either into finance lease and the second is operating lease. Can I say when all the risk and rewards are transferred, then such a lease is a finance lease? And can I say in case of finance lease, you have to de-recognize the asset. Under finance lease, lessor will have to de-recognize the asset and lessor will have to recognize the receivable equal to the present value of future rentals. You can say that another name is net investment. So under finance lease, you have to de-recognize the asset. Okay. In case of operating lease, obviously you are not supposed to de-recognize the asset. And operating lease means risk and rewards are not transferred. But please come here. The useful life of the asset is 40 years and we have given this asset on lease for how many years? 40 years. If an asset is having a useful life of 40 years and you have given that asset on lease for 40 years, so obviously it is a finance lease. And listen, under finance lease, you have to de-recognize the asset. Over here, instead of de-recognizing the asset, what they have done, it is still included in the non-current asset. And second, they are treating this as an investment property and they have adopted the fair value model. So obviously, existing accounting treatment is incorrect. This property should have been de-recognized. Instead of that, you should have recorded the receivables equal to the net investment, or you can say the present value of the future rentals. So there's clearly, we can see the mistake. Okay. The property was initially revalued to 22 million. Initially, it was revalued to 22 million. On 31st March exit, interim financial statement had indicated that gearing was 51% prior to this revaluation. Okay. The managing director was made aware of this breach of covenant and so instructed that the property should be revalued. The property is now carried at a value of 28 million, which was determined by the sale of a similar size property on 30th September X8. This property was located in a much more prosperous area and built with a higher grade of material. an independent professional value has estimated that value to be no more than 22 million. The managing director has argued that fair value should be referenced to an active market and is refusing to adjust the financial statement even though he knows it is contrary to the international accounting standards. Now listen. Number one, obviously the existing accounting treatment is incorrect. It is a finance lease. You should have de-recognized this building. You should have recognized the receivable equal to the present value of future rentals. Another thing is IFRS 13. IFRS 13 actually gives us the principle for fair value measurement. And a very important point is, see, when we say fair value, look at this, how they have decided to take 28. They are saying that with reference to the similar size property, and that similar size property was in a much more prosperous area. Now stop. The way you have taken the value 28, it is absolutely incorrect. Because when you are valuing a property, see, each area property will not have the same value. There are differences, and you have ignored that. And on the other end, the professional valuer is saying it has to be only 22, it cannot be 28. And managing director is, let's say, refusing this 22, they're saying no, 28 is correct. So obviously, even according to IFRS 13, we'll say that 28 million fair value is incorrect, which means that now try to understand. Initially, this property was bought for 20. Okay. Then 22, initially revalued to 22, now it is at 28. It means since you have treated this as an investment property, so we know that in case of investment property, whatever the change in the fair value comes, that goes to P&L, am I right? Profit and loss and retained earning. And this is already included in the books. Now, please come here. If we eliminate that 8 million from the retained earning, right now it is 70,253. If we eliminate this 8,000, so I'm going to get 62,253, am I right? Since the accounting treatment is incorrect, so we have to eliminate this 8 million. Obviously, when we are going to eliminate this 8 million, so retained earning will come to 62,253. Now look at this. Debt is 50. 10,000 plus 20,151 plus 62,253 into 100. Let's see. 10,000 plus 20,151 plus 62,253. 50 divided by this. Students, I'm getting 54.1%. Can I say logically, Fiskerton has breached the covenant? Yes or no? Breach has occurred. Something which should not have happened. It has actually happened. Now you're just manipulating the books, nothing else. What are the implications? Can I say the implication is your non-current liability will become current liability? Am I right? Non-current liability will become current liability. Not only this, you have to make the payment immediately. And it is mentioned in the question they are having negative cash balance, which means that there will be a big question on the going concern assumption of the business as well. And if the business going concern assumption is no more valid after this breach of covenant, then can I say entire books will be made on the basis of net realizable values. The presentation will change. Now, just a minute. I have tried to do the little hard work for you. I think you people can see this. Yes or no? Leases. Okay. See, how will you answer? Basically, you need to discuss lesser accounting. You have to just discuss finance lease, operating lease, then accounting treatment. You have to discuss the accounting treatment, fair value measurement, IFRS 13, and loan covenant. These are the points which you have to mention in part A. Now look at this. Fiscaton is a lesser. Lessors must classify leases as either finance lease or operating. A finance lease is a lease where substantially all the risk and rewards of the ownership transfer to the lessee. The useful life of the building and the lease term are both are what? 40 years. So the lease is a finance lease. For finance leases, the lessor should de-recognize the lease asset and recognize a receivable equal to the present value of the lease receipts. It is therefore incorrect to recognize the building as an investment property at fair value. The 8 million gain on remeasurement to fair value should be removed from the statement of P&L. Now, fair value is the price that will be received when asset is sold in an orderly transaction between market participant at the measurement date. I think I did mention earlier also, try to memorize this definition of the fair value. Market participant would factor in differences in condition and location when deciding on purchase price. How much percentage of useful life makes an asset under wow. Please, I think you people should have seen, if you ask me, I would say if you're using 75% or more of the life, then we say that lease is a finance lease. If asset is having a useful life of 10 years, and let's say you have given on at least for 7.5 or 8 years, then lease is treated as a finance lease. Over here, they have given for the entire life. I hope it is clear. If lessee is using 75% or more of the useful life of the asset, then that lease is treated as a finance lease. Okay. And look at this. The better indicator of the fair value is 22 million, not 28. Now, impact on debt covenant. Removing the fair value gain in the profit and loss would reduce the retained earning. This would be a breach of the loan covenant. The loan would need to be reclassified as current liability because it would be immediately repayable. Fiscaton may not be going concern, so uncertainty should be disclosed in the financial statements. I hope this is clear to everyone. Okay. I will upload this document as well. Don't worry at all with the video. Now in part B, in accordance with IFRS 15, revenue from contracts with customer, discuss whether revenue arising from the sale contract should be recognized on a stage of completion basis. Let's see. Sales contract. Fiscaton has entered into a sale contract for the construction of an asset with the customer, whereby the customer pays an initial deposit. Okay. The deposit is refundable only if Fiscaton fails to complete the construction of the asset. If you cannot complete the construction, then you have to refund the deposit. The remainder is payable on delivery of the asset. So remainder you will only be getting when, let's say, the work is 100% completed. If the customer defaults on the contract prior to the completion, Fiscaton has the right to retain the deposit. It is very important. Students, please listen. Initially, whatever deposit Fiscaton is getting, it is refundable by the Fiscaton if Fiscaton is not able to complete the construction of the asset. Okay. Something else is also written. That is, if the customer defaults prior to the completion, then the customer cannot pay you more. If the customer defaults, in that event, Fiscaton will not refund the deposit. Can I say other than that, still there is a possibility if you cannot complete the construction, let's say, you have to then refund the deposit. Only there is one event in which that deposit is not refundable. The event is if the customer defaults before the completion. Only then Fiskerton is not going to refund the deposit. The managing director believes that as completion of the asset is performed over time, revenue should be recognized accordingly. He has persuaded the accountant include the deposit and a percentage of the remaining balance for the construction work in revenue to date. Now listen. How many marks are there? 4. Simply, students, first you have to explain under IFRS 15, when do we actually recognize the revenue over time? After that, application. Now let's try to apply it over here. Can I say the deposit is not refundable only in the event if the customer defaults on the contract prior to completion? So otherwise it is refundable. You can see that. Otherwise it is refundable. It is written. So Fiskerton has entered into a sale contract for the construction of an asset which with a customer, whereby the customer pays an initial deposit. And then they say that deposit is refundable only if Fiskerton fails to complete the construction of the asset. A remainder is payable on the delivery of the asset. They are saying if you complete, then you will be getting the amount. Otherwise, you will not be getting. So basically, what is happening? How will you answer? First, key content, part B. Revenue recognition. Obviously, you're not supposed to write all the 5 steps. Just focus on this. Should we recognize the revenue over time at a point in time? Revenue is recognized over time if the customer simultaneously receives and consumes the benefit from the seller performance as they performed. At least I can't see this is happening over here. The seller enhances an asset that is controlled by the customer, or the asset has no alternative use to the seller and the seller can demand payment for the work performed to date. Something else is written. It says that if the customer defaults, only then you can take the deposit. The customer does not benefit from Fiskerton performance until the asset is completed. On completion, we will deliver this asset to customer. Fiskerton is not entitled to payment for the work completed to date because they can only retain the deposit if there is a default. Can I say as such, revenue is not recognized over time on a stage of completion basis. Revenue should be recognized at the point in time when the control passes to the customer. Did you get this, students? Azan is sounding, so just 1 minute break. Student, I hope this is clear to everyone. So basically 2 steps to answer. Relevant area of the relevant IAS or IFRS you have to first explain, and then application. Now let's go back to the question. Where is the question? Okay. Explain any ethical issues which may arise from the managing director and accountant from each of the scenario. Each of the scenario means 1 and 2. Can I say, obviously we have already decided their existing accounting treatment is incorrect. There's no doubt about it. Now, actually, we need to discuss on ethical issues. We need to discuss on ethical issues. And ethical issues which may arise from the managing director and accountant from each of the scenario. Now listen. Let's say if managing director deliberately kept the property at 28 million. If he deliberately did not de-recognize his property, then obviously it raises the question on the integrity, honesty, and obviously professional behavior of the managing director. And if we say that, let's say managing director was unable to identify that this accounting treatment is incorrect, then it raises the question on the professional competency of the managing director. When it comes to the accountant, can I say accountant has to be ethical? Accountant needs to make, accountant should know one thing, that users of the financial statement, they actually depend on these financial statements, and they make economic decisions on the basis of financial results. So accountant is supposed to be ethical. So now what are the responsibilities? Can I say accountant should persuade the managing director that existing treatment is incorrect? If managing director is not listening to the accountant, then accountant should talk to the non-executive directors. And accountant should take advice from, let's say, ACCA. And along with that, if nothing is happening, then accountant should be ready for the resignation as well. But I don't know practically who designs, but this is what we have to write to get marks. Look at this exam techniques, okay? Just answer starts from here. So we have to just write, okay? Exam technique, responsibility of accountant. All the time, then accountant will be worried about the job. Responsibilities of the accountants. Specific errors made and the potential impact on users. Incentive to misstate an ethical principle breach. Steps needed to resolve. Your answer starts from here. Responsibility of accountant. Accountants have the responsibility to faithfully represent the performance and position of an entity. These financial statements are relied on by key user groups when making economic decisions. Specific errors and the impact. The property error and the revenue error both overstate fiscal profits. This helps keep fiscal within the loan covenants, hence preventing the recall of the bank loan. As such, these errors are misleading the bank to the financial position of fiscal. Incentive to misstatement, ethical principle breached. If the errors were made purposefully by the managing director to mislead the bank, then that demonstrate lack of integrity, objectivity, and professional behavior. If the revenue error was unintentional, then it is still demonstrated a lack of professional competence. Steps to resolve. The accountant should discuss the issue with the managing director, encourage them to revise the financial statements. Accountant should discuss issue with the non-executive directors. If it cannot be resolved, accountant should legal advice. Do you think who has so much time to take legal advice and advice from ACCA and finally consider resignation? Wow. We are writing something which I don't think so anyone is going to follow in the real life. So students, I strongly believe this question should be properly understood by each and everyone. Is there any query on this question? I think it should be clear to everyone, each and everything. Now listen, please. It is, I would request, please try to attempt the test. Whoever does not have the time, so at least out of, I think there are 10 tests, if I'm not wrong. Out of 10, at least try to attempt 5 tests, and rest of the 5 you can take as a practice videos. Just read the question and watch the lecture. So in today's class, I just wanted to discuss this one question, and plus I just wanted to motivate you guys. Please try to complete the lectures as soon as possible so that you can have more time for the practice. And one final point, which I said earlier as well, please, to pass ACCA paper, SBR, any other paper, you need to put serious efforts. I think I mentioned after 2 more classes, we will start consolidation, inshallah. We need 2 more classes on these questions, and then we'll go towards consolidation. See, those students, they have completed, the strategy is very simple. Go back, and just see in which IAS and IFRS, what are the things which you must memorize. We are just discussing question like this in the next 2 classes also. So strategy, I'm doing one thing. After the prayer break, I'll share the strategy in both the groups. And that strategy will be for those students, they have completed the lectures, what they should do it. And those they have not done so far, so they should try to complete the lectures as soon as possible. So after inshallah prayer, I'll share the inshallah message. So thank you very much that you people have come out for this live class, live revision class. Thank you very much. Have a nice life.